Okay, we are going to talk about business valuation, basically just the nature and the purpose of valuations of business and financial assets. So, analysts use valuation models to estimate the intrinsic value of stocks and compare them to the stock's market prices to determine whether individual stocks are overvalued, undervalued, or fairly valued. In doing valuation analysis for stocks, analysts are assuming that some stocks' prices deviate significantly from their intrinsic values. Alright, so basically what happens is that analysts, they value stocks, They value stocks to determine whether they are overvalued, undervalued, or fairly valued. Okay, and if they are like major deviations, price deviations from the intrinsic values, the values of the market, of the stocks on the markets, then the analysts will use that information to trade. Okay, so if for example they determine that an asset is overvalued, then they'll have to sell all the stock that they have. Okay, if it's undervalued, then they will buy that stock. Okay, the belief here is that if the stock is undervalued, okay, it is going to go to its correct price, to its correct valuation, which means that the stock price will possibly go up. So if they buy the stock now when it's undervalued, they will seek to make a profit when the prices of that stock eventually go up in the future. Okay, and then we're going to talk about the major categories of equity valuation models. So the first one is the present value model. So basically the present value model is also known as the discounted cash flows. What you do basically is that you discount all the future benefits expected to be received from the security. So all the future cash flows that are expected to be received from the security in the future, they then want discounted to find the present value today. That is to determine the price of that security today. And then we also have what is known as multiplier models or market multiple models. These models are based chiefly on share price multiples or enterprise value multiples. So examples of multiples include price to earnings. You can also use price to sales and so forth. And then the third one is the asset-based valuation models. So these asset-based valuation models, they estimate intrinsic value of shares from the estimated value of the assets of the corporation minus the estimated value of its liabilities and its preferred shares. The estimated market value of the shares is often determined by making adjustments to the book value or the carrying value of the assets and liabilities. So basically, on asset-based valuation model, what we seek to do is to find the value of the assets of the corporation, and then we subtract the value of the liabilities of the corporation, and then that value that we remain with becomes the value of the corporation. We move on to dividend discount models. So basically the dividend discount model is based on the rationale that intrinsic value of stock is the present value of its future dividends. So what the dividend discount model does is, if you want to find the value of a stock today, is you have to find the value of all the dividends that are expected to be received with that from that stock, and then you discount them. When you discount them, that's when you find the value of the corporation. All right, so this can also be done on a yearly basis, like 1 year holding period dividend discount model. So for a 1 year period is the dividend to be received then you discount that plus the year-end price, which is also discounted. Okay, and then for a multiple year, for instance, here we are looking at the 2 year, so you discount the dividend to be received at the year of year 1 plus the dividend of to be received at the end of year 2. You discount that also plus the year-end price at the end of year 2, and then you also discount that to find the value of the corporation today. And then we move on to bond valuation. Okay, so the value of a bond, of a coupon bond, can be calculated by summing the present value of all the bonds promised cash flows. Alright, so you calculate the bonds promised cash flows, all of them, and then you discount all of them. And then when you discount all of them, that is when you come up with the what? With the value of the bond. So here we are going to an example on bond valuation. So the question reads, consider a newly issued 10-year $1,000 par value 10% coupon annual paying bond. The coupon payment will be $100 at the end of each year, and then the 1,000 par value will be paid at the end of year 10. So first we're going to value this bond, assuming that the discount rate is 10%. So we will discount the $100, the coupon that will be received in year 1. Okay, and you said our discount rate is 10%, and then we'll add the discounted coupon of year 2, the discounted coupon of year 3, and so forth. Year 4, year 5, we do the same. Year 6, year 7, year 8, year 9, and then at the final year we will receive the coupon of 100, but we'll also receive the par value of 1,000. So at the end of 10 years, the amount that we're receiving is 1,100. So we discount that also, and then we say the discount rate is 10%. So if you calculate all these discounted cash flows and you add all of them, you're supposed to get 1,000. So let's assume this for the same bond. Previously we had said the discount rate was 10%. Now we're going to assume discount rate of 8%. We will do the same. We will discount all the cash flows from year 1 up to year 10, but now we're now discounting with 8%. If you calculate that, you will find that the value of the bond is $1,134.20. Okay, so if the market discount rate for this bond were 8%, it would sell at a premium. Okay, a premium of $134.20 above its par value. When the bond yield decreases the present value of the bond's payments, its market value increases. And then for the same bond, we are now going to assume that the discount rate is 12%. So if we discount all those cash flows now at 12%, we'll find that the value is now 887, which means that this bond will be selling at a discount of $118, which means the market value of the bond decreases. And then we are now going to calculate for a bond with semi-annual coupons. Okay, let's say the bond pays coupons semi-annually, that is twice a year. So rather than receiving $100, you'll be receiving $50 every 6 months. And then we had assumed that the discount rate is 8%. So since we are receiving $50 every 6 months, we are now going to discount it 4%. How do we get this 4%? We say the yield to maturity of 8% divided by 2, and then we get 4%. So we now have 20 separate cash flows. Okay, so we're going to discount all these cash flows at 4%, and then you get that the value of the bond today is now 1,135. So we're now going to look at a zero coupon bond. Well, this is a bond which pays no coupons at all. Okay, so let's say that we've got a discount rate of 3% for 5 years or 5 periods, and let's say the par value is 1,000. So this coupon is a zero coupon, which means there are no coupons being paid, which means you only get the 1,000 at the end of the period, which is 5 years. So the only cash flow that you can discount now becomes the 1,000 par value that you will receive at the end of 5 years. So you will discount that at 3% to get 862.61. Okay, we now move on to the efficient market hypothesis, which is also known as EMH. So this was developed by EMH when we first discussed the concept of market efficiency. And then the EMH is divided into 3 forms. First, we've got the weak form. The weak form of EMH says that current security prices should reflect all current available security market data. Thus, past data and volume market information will have no predictive power about future direction of security prices, because prices will be independent from one period to the next period. Okay, so basically we're saying that under the weak form EMH, prices they reflect all the past data that is there. Okay, so you cannot expect to receive returns if you're only trading on a past data, because it is known by everyone in the market. The prices, they reflect that. And then we've got the semi-strong form of market efficiency. The semi-strong form of EMH holds that security prices rapidly adjust without bias to the arrival of all new public information. As such, current security prices fully reflect all publicly available information. Okay, so all information that is there, it is all reflected in the prices of the securities. Okay, so the implication is that an investor cannot achieve positive adjusted returns on average by using fundamental analysis. And then finally, we've got the strong form market efficiency. The strong form EMH says that security prices fully reflect all information from both public and private sources. So security prices, they reflect all the information that is available, whether it's in the public domain or it's from the private sources. The strong form includes all types of information: past security market information, public information, private, that is inside information. This means that no group of investors has monopolistic access to information relevant to the formation of prices, and none should be able to consistently achieve positive abnormal returns. Okay, it is not possible to achieve abnormal returns using information, because all the information is available to all the investors. All information that is public or even private information.